Hi everyone. Now we are going to begin with a new lesson which is dividend policy. Okay, a very simple, very easy chapter. Now we all know that equity shareholders, they want dividend, right? Equity shareholders, we pay them dividend. That is the cost of capital for the company, and payment of dividend is the return which the equity shareholders expect. Okay, so we give them dividend. But how much should be the amount? What should be the rate of dividend? Okay, all that is also important. So that is the policy. It is just not some random decision made. Okay, so it is based on the policy which the organization follows. Obviously there has to be profits, everything has to be taken, there is a shareholders approval, all that is there, but there is a policy which has to be followed for payment of the dividend. It is the policy is the thing which determines what portion, okay, the dividend payout ratio, what portion of earnings will be paid out to the stockholders and what portion will be retained in the business. So it has to be as per that policy. Dividend is nothing but it is distribution of profit. Okay, so dividend constitutes cash flow that accrues to equity shareholders, whereas retained earnings are one of the most significant sources for financing the corporate growth. Yes, when the retained earnings are high, you can use and plow them back for your further investments, right? Both dividend and growth are desirable, but they conflict to each other. There are investors who say that do not give dividend. High dividend makes no sense. You should in fact keep them. Retained earnings should be high and it should be plowed back so that the returns are high. Okay. Now, types of dividend policy. Basically, there are only 4 types of dividend policy. In that also, there is a bifurcation in 2. Okay, now the first one is the simple one. There is a regular dividend policy. Now, regular dividend policy is, say, take an example of Indian Oil or ONGC. Okay, they are the ones who pay you regular dividend where the rate of dividend is constant. Okay, their dividend rate is constant. The amount will keep on changing based on the profit on which they are declaring the dividend. Okay, so the rate is constant. The company is also having regular earnings. Okay, based on that regular earnings, so say today their earnings is 1 lakh. On that the rate is constant, 10%. So you will get 10,000 as your dividend. Or tomorrow they have earned 2 lakhs. Your rate is staying constant only, but your amount will fluctuate. Okay, so regular dividend policy. In this type of dividend policy, the investor gets dividend at usual rate. Okay, here the investors are usually those person who want to get regular income. This type of dividend payment can be maintained only if the company has got regular earnings, of course. Okay, merits of regular dividend policy, it is to create and keep the confidence of the shareholders. So generally those startups, the ones who have started the business, they will always give good dividend to their shareholders to keep the shareholders there. Stabilize the market value of the shares. The moment the dividend is given, declared value of the share increases. It helps in marinating the goodwill of the company. It helps in giving regular income to the shareholders. Now there is a stable dividend policy. Here certain sum of money is always given in form of dividend and the rate will differ. Certain sum is always given. Rate is not constant over here, but the amount is constant. Stable dividend policy. Now that amount can be in the form of constant dividend per share. Constant, same dividend per share. Rupees 6 per share. Rupees 2 per share. Okay. So in this case, the reserve fund is created to pay fixed amount of dividend in the year when the earnings of the company is not enough. Okay, it is suitable for the firms having stable earning, but if the earnings are not enough, they create a separate reserve. From that dividend per share they will pay, not percentage. Per share it is stable. 2 rupees, 3 rupees. Okay. I get ONGC payment of dividend, they pay me 6 rupees per share. It is there like constantly, always there. Then you have constant payout ratio. Now constant payout ratio, again it is similar, okay, to the regular dividend policy. Here there is a fixed rate, fixed percentage of earning is paid as dividend every year. Fixed percentage of earning. So it is the same type. Under this type, it is the same like the regular retained earnings. But in stable dividend policy, this is also one part. Okay, so here again there is a fixed percentage of earning is paid as a dividend. And in this stable dividend, the third one is you have stable rupee dividend plus extra dividend. So extra dividend will depend. You have this stable rupee dividend per share, rupees 6 per share you will get dividend. This is stable. If the company has made extra profits, have generated more, there is a lot of profits which is there is lot of amount which is there in the reserve. So they give this extra dividend in form of bonus. Okay, so this year they might get it, next year they might not get it. Okay, so there can be extra dividend in the year in which company has really earned high amount of profit. Okay, so merits of stable dividend policy, again the same thing. All the merits are the same. So if you see, it is more or less the same thing. In one, which is the regular payment, regular dividend policy, the percentage is fixed, the amount will keep changing. Okay, here the amount, certain amount of money per share is fixed, the rate can be different. Okay, and there is an extra dividend paid on your stable rupee dividend policy only if there is a high amount of profit in that given year. Okay, so this is what is very, very important from your theory point of view, very important. Okay, your types of dividend policy, very important. This is what is important in the chapter, and then the different theories of dividend. Now irregular dividend. So as the name suggests, they are not regularly paying the dividend. Okay, they see if the dividend has to be paid in this year, and the rate also changes, the amount also changes. So they don't have a regular dividend payment policy at all. Okay, this can be due to uncertain earnings of the company. They do not have liquid resources. They are sometimes afraid of giving regular dividend, and uncertainty of the business also. And no dividend means they are more towards growing the company for and investing that for their working capital, instead of taking that money out from the company and giving them dividend. So there is a no dividend policy also. Okay, so basically there are four. You have this first, which is regular dividend policy. In second, you have three parts, which is constant dividend per share, constant dividend payout ratio, and stable rupee dividend plus extra dividend. Then the third one is irregular dividend, and fourth is no dividend. Can be any of the four policies. Okay. Now determinants, constraints of dividend policy. The main consideration while payment of the dividend, first is your company law itself, Rule 3, Schedule 3, which talks that dividend cannot be paid if there is a loss or if there is an appropriate profit. Then the percentage of dividend has to be only up till 10%. So all those legal requirements can be constrained, for payment of the dividend. Financial constraint. Okay, that is also one consideration. There is no money only to pay. There is no sufficient cash to disburse it in form of dividend. Economic constraints, economic conditions. Okay, where the value of the firm is getting affected due to the payment of dividend. Nature of the business conducted by the company. Okay, now they want retained earnings to be plowed back to the working capital. Obviously, dividend here will be less, or there can be no dividend. Existence of the company. The length of the existence of the company also depends. With their long-standing experience, the company may have better dividend policy than the new companies. Of course, because the companies which are there since years, they already have got a confidence built amongst their shareholders as compared to the new companies. Type of company, organizations. Okay, now whether it's a private limited company or a public limited company, that will also affect the decision of the dividend. Financial needs of the company. If the company is needing more funds, They will keep the retained earnings and they will give less dividend. Okay. So financial needs of the company is also important. Market conditions, whether there is a inflation, whether there is a deflation, depression in the market, based on that. Okay. Now during the boom period, company will like to save more. They will like to save more and create reserves and growth and expansion. Okay. But during the recession period, they will say that, okay, let's keep our shareholders happy by paying some dividend. As it is, there is recession. Then financial arrangement. Okay. Where there is mergers, amalgamations with another company. Okay. There is a liberal policy of dividend distribution to get more, attract the stock market. Change in the government policies will also is one of the factors which will affect your dividend policy which you select. Now, types or forms of dividend. There are 4 types. First, which we all know, cash dividend, payment of dividend in cash. Okay, sometimes the companies also give bond dividend. Stock dividend, bonus shareholders, bonus shares is stock dividend, and last one is your property dividend. Let's read each one of them. Cash dividend we all know, the common type which all the companies follow. Stock dividend is in the form of company stock due to raising of more finance. Okay, so basically cash is retained by the business concern, so that cash is capitalized. That is stock dividend. Okay, stock dividend may be a bonus issue. Then similarly, you can have a bond. A bond is given in form of dividend. It is known as a scrip dividend also. Okay. So if the company does not have sufficient cash to pay the dividend, then they promise the shareholders that they will give you a specific bond of specific date. Okay. Issue of bond or issue of notes. And property dividend, it is not regular in India, but property dividend is that type where it is used during liquidation and winding up. A private limited company says that, okay, fine, I will take away this particular asset, this particular property I will take, I will pay this much. Okay, so at the time of liquidation, this is also told, the name given is property dividend. It is an alternate to cash or stock dividend. It is a property dividend can either include shares of a subsidiary company or physical assets such as inventories that the company holds. The dividend is recorded at the market value of the asset which is provided. Okay, it is distributed under exceptional circumstances, liquidation, winding up, and it is not prevalent in India. Theories of dividend is all what the sums we have done. Okay, we have done 2 types of theories. Okay, one where is relevance of dividend. Relevance means payment of dividend or non-payment of dividend will affect the price. Affects the price, market price of the share. Irrelevance means the price does not get affected irrespective of whether you are paying dividend, not paying dividend. Price is not affected. One is Walter's model, second is Gordon's model for relevance dividend, and then we have Modigliani and Miller's approach where he talks about irrelevance dividend theory. Now, relevance dividend theory, Walter's model, as per the sums, Walter's model and Gordon's model are one and the same. Walter talks about dividend payout ratio in sense of dividend payout ratio, and Gordon talks about in form of retained earnings ratio. Okay, both of them have some of the same assumptions which they have kept in order to give this particular theory. Now, what does Walter say? He has kept the following assumptions. First, he says the firm will finance all its future investments through retained earnings. Okay, therefore there is no new debt, no new equity issue. The firm's internal rate of return R and the cost of capital, equity capital, remain the same. They are constant. All earnings are either distributed as dividend or they are reinvested internally immediately. Beginning earnings and dividends never change. Okay, the value of earning per share and dividend per share may be changed in the model to determine the results, but the given values, earning per share and dividend per share, we assume that they will remain constant forever. and the firm has a very long or an infinite life. Okay, these are his assumptions. So the formula given by him is the price is nothing but dividend plus your return on investment upon your cost of equity, earning per share minus dividend per share upon your cost of equity, market capitalization rate. This we have solved in the sums. Okay. Now, from the Walters view, an optimum dividend payout ratio can be summarized as follows. What does he say? That a growing firm, okay, if they have their internal rate of return R greater than their cost of equity, then it is known as the firm is growing. Okay, that means they have got ample profitable investment opportunities. Okay, so in that case, these firms naturally can earn a return which is more than what the shareholders could earn on their own. So the optimum payout ratio for the growth of the firm is 0. So here he says that the dividend payout ratio should be 0. Give 0 dividend when you have the ability to grow. Normal firms where the internal rate of return is the same as the cost of equity, these are normal firms. Okay, these firms can earn a rate of return which is equal to that of the shareholders if they invest by themselves. In this case, dividend policy will not have any influence on the price per share. So you can have, so there is nothing like optimum payout ratio over here. And declining firms, okay, since they are already declining, might as well keep the shareholders happy, at least give them dividend. If the company earns a return which is less than what the shareholders can earn on their own investment, then it is known as a declining firm. Then here the rate dividend payout ratio should be more, 100%. Okay, you should give more dividend, maximum dividend basically. So here I can say it is maximum dividend. Here any, whether you give, don't give, and here it is 0 dividend, minimum dividend. All right. Okay. However, the criticisms on the models are, first of all the assumptions which they have made is unrealistic. Okay. Now here criticisms on model are saying that Walters model of share valuation mixing with the dividend policy and with the investment policy is mixing everything. The model is assuming that the investment opportunities of the firms are financed by retained earnings only. So all the assumptions which they have made are the criticisms which are there in the model. Okay, unrealistic assumption. Okay, that R is always constant, internal rate of return is always constant, KE is always constant. No, it is not possible. A firm's cost of capital or discount rate, KE, does not remain constant. Even this does not remain constant. It changes with the change in the risk. Okay, so obviously it keeps on changing. Similarly, with Walters, same thing is there given by Gordon model also. Okay, again here there is another theory, Gordon's model, which he says that the dividends are relevant and they affect the price. It is on the same lines like Gordon's model. Okay, they say that it will affect the value of the share and value of the firm. So here he says the assumptions are all equity, there is no debt at all. Okay, there is no outside financing, any new financing with retained earnings. R remains constant, K is remaining constant. Firm derives its earning in perpetuity. Retention ratio once decided upon is constant. So B is your retention ratio. Okay, growth rate is also constant. So basically your G is equal to your retention ratio. Okay. Corporate taxes do not exist. Your cost of equity is always more than your growth rate, and retention ratio always less than 1. Okay, that is your B is always less than 1. These are his assumptions. Based on that, he is given the formula wherein E is the earning per share, 1 minus B is your dividend payout ratio upon KE minus your BR. B is nothing but your growth rate into rate of return on the investment. Okay, this we have already solved in the sums. So if here he's saying that optimum payout ratio for a growing company means where your internal rate of return is higher than your KE, so your payout ratio has to be 0. That is what we did in Gordon's model also. So basically your retention should be maximum, retain maximum. Here your dividend can be any, and here your dividend has to be 0. You can retain minimum. Okay, so they both conclude, the conclusions, both the policies are the same. Now the third one is your dividend irrelevance, Modigliani-Miller theory. He says that dividend policy has nothing to do with the price. Okay, obviously, in fact, payment of dividend also increases the wealth of the shareholders. Okay, it is like a capital, it's a gain. Okay, they're expecting this amount of return also, at least some amount. Okay, and always not retained earnings are plowed back. You need more and more terms of finance and sources of finance for your future investment, and the cost of the capital keeps changing, it's not constant. Okay, following are the assumptions of M&M hypothesis. Capital markets are perfect. Here he says investors are rational, information is freely available, transaction cost is nil, securities are divisible, and no investor can influence the market price of the share. This is his first assumption. However, there is no taxes. There is no difference between tax rates and dividends and capital gains. There is no tax rate at all. Capital gain is also free of tax. Dividend is also free of tax. The firm has a fixed investment policy which will not change. So even if the retained earnings are reinvested, there will be no change in the risk of the firm. Therefore, K will always remain the same. Flotation cost does not exist. Okay. Last one is your marginal analysis and residual theory of the dividend. Residual theory means what? That first your dividend, they say, see, we'll read this. Residual theory of dividend assumes that if the firm has retained earnings which is left over after all the expenses which they have made, after all financing all acceptable investment opportunities. So say firm has some 2-3 investment opportunities and they have already ascertained the amount of this investment opportunities. After deducting those amounts also, there is some retained earnings which is still left. That residue, give it as a dividend. Okay, so they are saying that say there is some amount of retained earnings which is say 100 crores. And they have already ascertained the cost of one future investment opportunity which is 50 crores. So now whatever is then residue left over, okay, this you can give it as a dividend. That is known as marginal analysis and residual theory of dividend. So your residual theory of dividend assumes that if the firm has retained earnings left over after financing all the acceptable investment opportunities, these earnings would then be distributed to the shareholders in form of cash dividends. If no fund is left, no dividend will be paid. In such a case, the dividend policy that results is strictly a financing decision. Why? Because you have already financed your other investment opportunities. As a result, the payment of cash dividend is passive. Okay, if it is left, we will give. If it is not left, it will not give. Nothing is in our hands. Okay, thus a treatment of dividend policy as a passive residual determined strictly by the availability of acceptable investment proposal. If you have some acceptable investment proposal and you are ready to finance it, you remove that amount and whatever is left, you pay the dividend. Okay, so this implies that dividends are irrelevant. The shareholders are indifferent between the dividends and retention. Thus, if available investment opportunities are plenty, the percentage of dividend payout will likely to be 0. Yes, it's because of this theory what it is saying. On the other hand, if the firm is unable to find any kind of future profitable investment, then the dividend payout ratio is likely to be 1. They will give a dividend. Okay, so marginal analysis and residual dividend theory is important from your exam point of view. Okay, so this is it with your dividend policy. Rest everything is also done with all my sums. Even my sums has certain conceptual theories which you have to read before you solve those sums. Okay, so when you will refer to those videos in which I am solving all the big problems, your dividend policy chapter is sorted. Okay, thank you everyone. Bye bye.